Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, we look to the October jobs report in the U.S., along with some big-name tech earnings. I'm Tom Busby in New York.
I'm Caroline Hepker here in London, where we're shining a light on equity and equality in the UK's financial services sector.
I'm Doug Krisner, looking ahead to the next meeting of the Bank of Japan, as well as the FinTech Summit in Hong Kong.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with the October jobs report. We get non-farm payroll numbers this coming Friday, 8:30 a.m. Wall Street time. And for more on what to expect and how this could impact Fed policy, we're joined by Michael McKee, Bloomberg International Economics and Policy Correspondent. Well, Michael, the 1st of November, just days before a contentious presidential election and a Federal Reserve policy meeting, we get the October jobs report. What are you expecting to see?
I don't know. I realize that that's not a satisfactory answer. Here's the problem: is we've had the two hurricanes, and we've had the Boeing strike ongoing. And the longer that goes, then suppliers to Boeing have to lay off people because they're not buying their parts and things like that. So there's some real unknowns about where this is going to come down. And the distribution of forecasts so far is very, very wide, all the way from about zero. And it's possible we could get a negative number all the way up to another surprise like we got last month, over 200,000. So it's really hard to tell what's going to happen. Now, the Fed is going to look past all of that external impacts on the economy, and they'll focus on the unemployment rate, which would not be affected by the hurricanes or the strike. And as long as that doesn't move too much, it won't really impact what the Fed thinks about the economy. But certainly a headline that says 0 jobs created or 250,000 jobs created might influence some voters.
So the unemployment rate expected to hold steady no matter what, 4.1%. But let's talk about that varying number, because the hurricanes were devastating. And Helene, the really bad one, North Carolina, that was actually in September. So it'll really show up in the numbers here, because the survey ends mid-October, right, for all these?
Yeah. We didn't see a huge effect for September. It was at the end of the month. So it depends on how fast people got back to work, which is one of the issues with this. Is we don't really have a good handle on it. Part of the problem is all the damage in the Appalachians in East Tennessee and Western North Carolina were, for the most part, in areas that are not heavily populated. And economists try to go back and look at the impact of hurricanes that have come before, but the ones we've seen in recent years have been things like Harvey and Houston. Well, that's a very populated area, and so maybe more people were out of work for a while. In this case, this was also much more destructive. Harvey flooded a lot, but this wiped out entire towns. We've all seen the pictures. And so those are jobs that may never come back. And how do you count that? I mean, it's really a rough model of how many people might live in the area and have jobs. So it's going to be really hard to know whether this is a huge impact event or not. The BLS should tell us what it thinks the impact was.
On the other hand, we have seen a bit of an upside surprise in weekly jobless claims since that hurricane, correct? The more destructive of the two.
Well, we saw an immediate bump, and then in the last week it came down. But the continuing claims have remained elevated, gone up a little bit because people are still out of work in those areas, but they're not filing new claims. Seems like the unemployment offices for those states were very efficient at getting people in and getting them on the rolls. But it does mean that the jobless claims numbers are much more volatile than they were, and that makes it also hard to try to figure out what the jobs numbers are going to be.
Now, let's go back to what you discussed before. You mentioned that strike, that massive, crippling strike at Boeing. The machinist union rejected a deal, 35% wage increase over 4 years. But this thing, it could be a long, protracted strike. How will that impact the economy going forward?
Well, it'll have a huge impact in the data because the Boeing is a major influence in durable goods, just because they're the most expensive durable good you can buy. One airplane is a lot of money, so we will see distortions in that. So you'll be looking at the transportation part of durable goods. The number of people who are out of work, if you're on strike, you're counted as employed but not at work. And so that won't have a major effect. But where you would see it is in the companies that make the parts that go into Boeing planes. Now, Boeing had been continuing to buy its supplies, and now they're cutting back on that. So maybe we start to see some, machine shops and things like that.
Well, Spirit Aerosystems, we've already seen.
Spirit Aerosystems lay off people, and those people may show up as unemployed, and that could have an impact on the jobless rate, although the feeling is it hasn't been fast enough to affect this month, but it could next month.
Well, the October jobs report coming out this coming Friday, 8:30 a.m. Wall Street time. Our thanks to Michael McKee, Bloomberg International Economics and Policy Correspondent. We move next to corporate earnings, with much of the Magnificent Seven reporting their latest results this week. Key names like Apple, Amazon, Alphabet, Microsoft, and Meta Platforms. For more on some of what we can expect, we're joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. Mandeep, thank you for joining us. Let's start with what we already know. This past week, Tesla, the first of the big tech names to post earnings, surprising Wall Street with a profit and an upbeat outlook. Do you expect this momentum to continue with some of the other big names, Apple, Amazon, Meta, Microsoft?
I think so. And what they said was, the demand for the cars is strong. And on the AI front, they seem to be making a lot of progress, where everyone was questioning their robotaxi timeline after the event. I think some of the fears went away with their earnings, and they had more clarity on the call in terms of what they are doing on the AI front. And that really bodes well for the big tech companies that are reporting next week, whether it's Meta, Alphabet, Amazon, even Apple. Simply because Microsoft is obviously the big bellwether when it comes to AI. And look, when it comes to cloud, there's been a big tailwind from AI spend, because all these companies that are raising their CapEx, that are setting up AI infrastructure, they are able to monetize it through their cloud. And we saw from Microsoft last quarter, the AI contribution to Azure was 7 percentage points. This quarter, it'll probably be higher, at least 9 to 10%, if you ask me. And look, if with Alphabet, they said it was multi-billions. They didn't quantify the percentage point contribution. I expect their cloud revenue, Google Cloud revenue, which is a $40 billion run rate business, will get a lift from AI. Same thing for Amazon. Amazon, given its size on the cloud side with over $100 billion run rate, probably will not have the same magnitude as Microsoft and Google, but clearly it will get a lift from AI. So that's the common thread. And Meta, we know they've done extremely well on the ad side because of applying AI for recommendations and ads. So I expect them to have a good quarter as well.
Well, yeah, the advertising mostly affects Meta and Amazon.
Yeah.
But cloud computing, like you said, seems to almost all of them have a hand in that, as well as artificial intelligence. Some more than others, though, with artificial intelligence.
Yeah, and look, given these companies will raise CapEx again, it'll be interesting to see how the markets react, because for cloud companies like Microsoft and Google, I think the reaction will be positive on CapEx increases simply because they are able to show the monetization in their cloud segment. For someone like Meta, I mean, clearly their growth rates are way higher than some of the smaller names like Snap, Pinterest. So I think that just goes to show they are executing very well on the ad side. But it's harder for investors to see how much of that CapEx increase is translating into real revenue. It's helping their product, but it's not a separate line as you have with Microsoft and Google and Amazon. And I think that's where it'll be interesting to see how investors react to Meta earnings, given expectations have gone up, but they'll probably come out and say we are raising their CapEx. And I think in 1Q, the reaction was negative. In 2Q, it was positive. So I'm expecting it'll be a mixed.
Are you expecting, is Meta going to be the standout this week out of those five?
No,
reporting?
if I had to bet my money, I would say expectations are lower for Alphabet. I mean, I would say a lot of folks are investing Alphabet to disappoint, given the pressure on their search business from OpenAI and Perplexity and all these new companies. So it's always about expectations, and you have to frame it in accordance to where investor expectations are. So investor expectations are lowest for Alphabet. And that's where, if they come out and say search business is holding up and they are seeing tailwind from YouTube and cloud, you will see a bigger stock reaction there compared to a Meta or Microsoft where expectations are already high.
Interesting. And of course, as you mentioned, advertising revenue is going to be always a big revenue gainer.
Yeah, I mean, and look, AI has shown that, you can get a lift in ad targeting from application of AI. The content recommendation is much better. So all those things are there, but they're probably reflected in Meta's estimates for 4Q and 2025 at this point.
Well, let's talk about the last of the Magnificent Seven, NVIDIA. We won't get Q3 earnings until November 19th with its new line of Blackwell chips. What are you expecting? Are you expecting more blowout news from NVIDIA, or has that kind of subsided a bit?
No, I think if anything, what Jensen has told us so far this quarter is demand is off the charts, and he is setting expectations for a blowout quarter. So if anything, I expect all the Mag 7 to do very well, beat and raise. I think Tesla was the one who could have disappointed. So we saw a beat and raise from them. I expect others to do the same. But with NVIDIA, the growth rate we are talking about 80% growth rate in the quarter, and they'll probably blow it out once again.
Wow, a lot to look forward to. Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. And coming up on Bloomberg Daybreak Weekend, we'll shine a light on equity and inclusion efforts in the UK's financial services sector. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, a look ahead to this week's Bank of Japan meeting and monetary policy decision. But first, as the UK celebrates Black History Month this October, a spotlight has been placed on diversity and inclusion efforts in the country's financial services sector. In the wake of the Black Lives Matter movement, British companies claimed they wanted to seriously address racial disparities. But 4 years later, have those commitments been honored? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, black workers and diversity practitioners in the City of London have told Bloomberg that corporate priorities are shifting away from diversity. That's as research from Bain Consultancy and the Black Talent Charter estimates that at the current rate, it will take 50 years for the proportion of black talent in financial and professional services to get close to 4.4%, which is the percentage of black employees in the UK's working age population. Despite issues surrounding diversity coming to the fore in 2020 after the murder in the US of George Floyd, black representation in financial services has not significantly improved since then, and in some sectors it's worsened. Bloomberg reporter Tiwa Adebayo has spent weeks investigating how firms in the City of London have quietly rolled back on efforts to diversify their workforce, a contrast to the public pledges that global corporations made after the outcry that was sparked by Floyd's murder in the US. Those that she spoke to said the city has, quote, given up on inclusion efforts, leaving black workers feeling abandoned and quitting the sector at a higher rate than their peers. But change could be afoot. While reporting on the ethnicity pay gap is not yet mandatory in Britain, the new Labour government recently committed to introducing a draft bill mandating it in this parliamentary session. Many finance firms have already started publishing the data. Overall, DEI professionals say a more deliberate approach needs to be taken. That was the opinion of Mark Lomas, who is the head of culture at Lloyd's of London, who spoke to Tiwa Adebayo for the piece.
I think we see this challenge across lots of employers, and that is essentially making sure that your processes are fit for purpose, you are deliberate in how you go out to attract talent, you have inclusive recruitment practices, and then you have the ability and the practices to retain talent. I think at the Lloyd's market, why we've been so successful is because we've had a very deliberate approach to it. It's not impossible, but it takes concentrated effort.
Can you tell me a bit more about what you're doing in terms of retention? Because when we look at the statistics, it shows that black talent drops off at a sort of mid to senior level. So they're coming into the profession, but they're not staying. Can you shed some light as to why you think that might be and what you're doing to combat it?
I think for every company, it's a little different. The reality is the further you go up the company structure, the less jobs there are. So I think companies that are very successful with retaining people do have a number of support structures in place. So I think the key to success is making sure that you've got diversity, equity processes built in to your employee life cycle. Without that, without the data to make informed, intelligent interventions, progress is slower. And then, with the drop-off, in the Lloyd's market, the MP&P survey does say that there's slightly higher attrition rates for black and ethnically diverse groups than others. However, that is perhaps that talent moving from job to job within the market, not necessarily leaving the market. I hate to make a judgment call without the facts, but I think the stats point to that.
Specifically, when thinking about the underwriters in your market, how do you support them to ensure that their black employees are not just there but having a good experience? How do you build a culture that makes people want to stay?
So there is a wealth of support available. And, the reason for that is, one of the aims of our culture strategy is to ensure inclusive practices that enable high performance. And we are very clear that the more inclusive it is, the more people have an opportunity to speak up, to share their views, to feel included. That is better for the end outcome. We have a good focus on making that happen.
What about speaking out publicly compared to supporting internally? Can you speak to the importance of doing that? And is that something you try to do at Lloyd's?
So I think that's very different for different companies. So, in George Floyd, during the kind of aftermath of the George Floyd killing, lots of companies kind of were very public and effusive about their statements around race equality. Maybe some of that hasn't been followed through. I think for each company, it's important to do what's right and what your employees or what their employees think is the best thing. At Lloyd's, we take an approach that we listen to our employees and we respond in the most appropriate manner rather than having a blanket kind of approach to it. But yes, it is very important that employees have a voice. They're able to talk about what's important to them. And that is something that we do consistently. So it's not a case of just reacting to an event. We're consistently promoting people's stories. These things are part of the fabric of working for Lloyd's and increasingly throughout the Lloyd's market as well.
I'd like to talk briefly about 2020 then and that sort of groundswell of feeling. I know you weren't at Lloyd's at the time, but as a D&I professional, how did it feel to see issues that you'd been talking about for the length of a career suddenly thrust into the forefront?
So look, it's always good when there's a focus on diverse talent, and I would like it not to have to be as a result of a horrendous situation, regardless of the group that's affected by it. But look, it's positive when there's a focus on these things. However, it's more positive when there's follow through.
That was Mark Lomas from the insurance marketplace Lloyd's of London. So just how equal is the City of London, and are firms making any progress? It's something that I asked Tiwa about as she walked me through her in-depth reporting on the subject.
So, Caroline, one person actually summed it up really well, and that person is Pauline Miller. She's got 20 years of experience running DEI at firms across the city, including State Street and Barclays. And what she said to me is that at the moment, we're experiencing this perfect storm of economic headwinds, industry backlash, and also disappointing results from initiatives, which is driving a real pullback from a lot of city firms. And that's been reflected in the accounts of black employees that I've spoken to, many of whom wanted to keep their identities private. They've said they've noticed subtle changes. So fewer Black History Month speakers, for example, fewer networking events for people of colour. So we're not seeing the same regulatory pressure that is present in the States just yet. But firms are reassessing their commitments, and that's proven in the data as well. I spoke to the Taylor Bennett Foundation, which is an organisation that operates across the communications landscape, placing diverse candidates in firms such as HSBC and Santander. And they said that demand for their paid internship programs has actually seen a 25% decline year on year since 2022. And that's despite seeing a big uptick in interest in 2020, particularly following the murder of George Floyd. And that drop in demand is coming specifically from financial services and city firms. I also spoke to Junior Garber, who founded a similar group called Equity City, which works to get ethnic minority candidates into the city with a focus on insurance. And he said the same thing. Budgets are dwindling. And really at the heart of the problem seems to be this lack of concerted effort from firms. I spoke to one person, Mark Lomas, who's the head of culture at Lloyd's of London, and he set out the problem really during our conversation. He said making real change takes very deliberate and targeted effort, and not all firms are willing to do that. So here's a bit of what he said.
I think we see this challenge across lots of employers, and that is essentially making sure that your processes are fit for purpose, you are deliberate in how you go out to attract talent, you have inclusive recruitment practices, and then you have the ability and the practices to retain talent. I think at the Lloyd's market, why we've been so successful is because we've had a very deliberate approach to it. So it's not impossible.
So that was Mark Lomas, head of culture at Lloyd's of London, that you spoke to. You also report on black workers facing a ceiling at work or leaving. It is having an impact on people in their working lives.
Yeah, from my conversations, it seems that an unintended consequence of this urgency to act on diversity felt by a number of city firms in 2020 was that some of the DEI strategies that were focused on recruiting black talent were rushed, and they did it without adjusting company culture first. And that's really showing in the experiences of black employees and, crucially, the number of them leaving. So the data shows that black talent is leaving firms in the city before reaching the top ranks. So at UK law firms, black people are 4 times more likely to leave than their white counterparts. In investment banking, actually, the figure for representation at a more senior level sits at just 0.5%. And we can see in the ethnicity pay gap that's persisted too, particularly for black workers. So that also suggests concentration at a junior level. But employees that I've spoken to really speak to this phenomenon of joining through a black-focused recruitment scheme like the Taylor Bennett Foundation or 10,000 black interns, and then feeling abandoned without a clear pathway to progression in their career, and that contributes to attrition, to them leaving. So one of those people was Karen Miperere. She's a former private equity investment operations analyst, and she's now an analyst at a large UK bank. And she says that since 2020, there has been divestment from DEI, and it's hurting her experience.
Now it feels a bit more like that conversation has almost sort of been put to the back burner. And with the economic contraction and sort of companies having to reconcile with overhead and challenges I think DE&I was the first thing to go, really. And it was subtle things like, you know, maybe there wouldn't be as many networking events for people from same backgrounds. And maybe for Black History Month, they wouldn't do quite so many things and there wouldn't be quite so many speakers. But bit by bit, it does feel as though it's not really as much of a priority as it used to be. And I think that really trickles down into then your working life as a Black woman.
So that was Karen Muperere, one of the people that you spoke to in this investigation. You've also done some granular reporting. I mean, you've talked a lot about the data, and data tracking is another issue. The BAME umbrella, which in the UK refers to Black, Asian and minority ethnic people. There's also an issue with this in the data.
Yeah, so that was actually one of the most interesting parts of this reporting, the existence of this data gap as it pertains to Black talent in the city. Black employees and other employees have to volunteer that ethnicity information about themselves, and it hurts the progress of DEI.
My thanks to Bloomberg's Tiwa Adebayo. So, is corporate diversity a fading trend or an issue being brought to the fore once again? We shall perhaps have to wait to see. For more, you can listen to Tiwa's conversations in full about these issues on Bloomberg's In the City podcast with Francine Lacroix. I'm Caroline Hepker here in London, and you can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, what to expect from a monetary policy meeting this week at the Bank of Japan. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. As the yen weakens, there's growing speculation that Japan's central bank is looking to raise interest rates in the coming months. Could the BOJ start this week? Let's turn to Bloomberg Daybreak Asia podcast host Doug Krisner for a closer look.
Tom, last month, the Bank of Japan signaled it will slow walk its next rate hike. That represents a significant pivot from the BOJ's previous guidance. So what changed to trigger that shift in the BOJ's thinking? Joining me now is Paul Jackson. He is Bloomberg team leader for EcoGov in North Asia, joining us from our studios in Tokyo. Paul, it's always a pleasure. I thought the BOJ was squarely on a path toward normalizing policy that would have increased the possibility that we could have a rate hike in the next week, but something changed. What do you think it was?
Well, I think they are still on track to raise interest rates at a gradual pace over the coming months, but not at this particular meeting. I don't think we're in for any Halloween surprise. I think what we saw in July was a lot of market instability following the rate hike decision then. Of course, it was largely influenced by US data, but we saw the meltdown in markets in August. And certainly in Japan, some of the blame was heaped upon the BOJ, although it was a very small rate increase that they actually did. So I think they're wanting to steer clear of any finger pointing this time and take their time before making the next move. Now, we did have the deputy governor speaking here at Bloomberg in Tokyo recently, and he said, it's very complicated when you look at the BOJ communications to try and unpick what it means. But essentially, if the inflation outlook continues as we expect, we are going to continue raising rates. And so far, it looks that's what they're going to do. So it's a case of when do they move if they don't go in October.
So you mentioned inflation there, Paul, and my recollection is that core CPI is running at about a 2.4% annual rate. Now, we know that inflation in Japan has been elevated for some time, and yet the BOJ has been very, very cautious to tighten. Explain that thinking.
Well, it's because it's been a national goal in Japan to spur price growth that then feeds into wage growth and higher consumption and higher growth for the economy. So in a sense, in Japan, inflation is seen as a kind of positive force among policymakers. I think the average person on the street may have a different view about that. But the central bank essentially has been wanting to be very cautious about normalizing policy and raising interest rates because it wants this nascent inflation trend to hold, to dig in, keep roots, so that we have a kind of anchored 2% inflation trend again, and all the money in Japan gets moving around again. I think that's the goal, and that's why they've been cautious.
So you mentioned man on the street in Japan. I'm thinking that a weaker currency is a part of that story. And before we get to the performance of the yen, I want to get a sense of what market participants are saying right now about the BOJ decision. Earlier, I spoke with Peter Maguire. He is the CEO of XM Australia. Let's listen in. There seems to have been a little bit of a policy pivot right now. Perhaps the BOJ slow walking the next rate hike. How are you feeling about what the BOJ may deliver?
Well, I'm thinking that we won't see a rate hike, and it's just, they might again push it out. You've got that yen has been, nearly 151, so it's been incredibly volatile. We've got a very strong stock market. The Nikkei's performed extremely well over the last 12 to 18 months. Everyone knows that. So it's a market you couldn't be not be involved in. I think that, the situation in Japan is it'll be a push out, and we're not expecting anything dramatic to happen. But it's full of surprises, and I'm not going to say that it won't happen, but at the moment I'm more in the camp that it won't happen than will happen.
So even though the BOJ is signaling it may push out a rate hike, do we have to be worried about maybe a little bit of intervention from the Ministry of Finance when you're talking about a yen that's flirting with 151? Yeah,
I think so. I mean, it's always on the back of everyone's mind. If it was to tick higher, then naturally, if you get that 155, you could see some form of intervention. And you can't rule that out because it was only a couple of weeks back. It was running at that 143, 144. So it's, again, an incredibly volatile trade, the yen dollar. And I wouldn't be surprised that you see it edge up even higher from here, maybe a 153 handle. Doug, you might even see a 154, but it's got momentum at the moment, and you can't stand in the road of it because it'll run you over.
He is Peter Maguire, the CEO of XM Australia, in an earlier conversation on the Daybreak Asia podcast. Back to Paul Jackson in Tokyo. Paul, do you think there's a risk right now that we have to talk about it as it relates to intervention to defend the currency a bit?
Well, I think we are getting into the territory where officials at the Finance Ministry are going to be feeling nervous. When we got into the 150 mark, the top FX official came out with warnings, just saying they're keeping an eye on it, on speculative moves, any one-sided moves. Those warnings haven't been ramped up, and I don't expect they will be until we get much closer to the 160 mark. But I think an interesting point here is we had former BOJ Executive Director Monma on speaking at Bloomberg in Tokyo recently, and he said he thought that the decision in July to raise interest rates was 80 to 90% based on weakness in the yen at that time. And he said if the yen is 150, 155 against the dollar, then that is going to be putting pressure on the BOJ to think about moving earlier. Now, I think the context of his remarks suggests he's talking, maybe move in December rather than wait until January or later next year.
The other thing that I think is interesting, that the Fed has kind of been speaking to this idea that maybe it needs to modulate the rate at which it intends to cut interest rates in the U.S. So if rate cuts in the States get pushed out just a little bit, what does it do to the yield curve in a way that would influence the BOJ's thinking, do you think?
The pushing out of rate cuts by the Fed, that feeds straight into the yen and, puts extra weakening pressure on. So, the longer it takes for the next cuts to come in, or the more expectations are moved back, the more pressure there is on the yen. Now, if you look at the meetings, we've got this meeting on the 31st of October. The next one isn't until December. So that's quite a long time away, and a lot's going to happen in that time. So can we rule out intervention in that time? I don't think we can.
Paul, it's always a pleasure. Thanks so much for making time to help us preview the BOJ meeting. He's Paul Jackson, Bloomberg EcoGov team leader for North Asia. joining us from our studios in Tokyo. We turn next to Hong Kong's FinTech Week. It will get underway in the days ahead. FinTech Week is dedicated to exploring the future of digital assets and, at the same time, fostering innovation within the community. 30,000 attendees are expected from over 100 different jurisdictions, and organizers are saying the event can serve as a platform for incubation. For a preview now, I'm joined by Bloomberg's Annabelle Drulers, Bloomberg tech reporter. She's based in Hong Kong, and she will be covering FinTech Week. Thank you for making time to chat with me about this. Can we take the big picture here? You've got a little bit of experience with what goes on here, and help me set the stage.
Well, I think it's a really interesting stage to set because it comes at a kind of a pretty crucial time for Hong Kong's crypto pivot. You think about where Hong Kong is going with this and the sort of inroads that it's made so far, and a lot of people in Hong Kong would tell you it's probably not panning out quite as had been expected. This conference that's coming up this week, they're saying it's one of the biggest in Asia, of course. Maybe some of the conferences that are held in Singapore might beg to differ on that front, but still there's a speaker lineup that really speaks to perhaps the city's unique interpretation of crypto, because on the one hand, you do have those sort of more traditional pure crypto players that are going to be attending. So Bullish, for instance, that's a crypto exchange based in the US. There's Vara, it's the regulatory authority from the Middle East, from the UAE, and Chainlink as well. That's another one that's sort of more on the institutional side, but still Hong Kong has a heavy host of fintech, insurtech, traditional tech businesses, VCs. They're also going to be in attendance.
What's the regulatory environment like in Hong Kong? Is there one, really?
Yeah, there's definitely a regulatory environment in Hong Kong. But again, going back to that point I made, 2022 was when they signaled that they were wanting to start licensing retail crypto exchanges. And fast forward a couple of years, yes, you've got 3 that are licensed, and some might say that's enough because at Hong Kong, of course, it's only around 7 or 8 million people. But at the same time, there's maybe around 13 that are deemed to be licensed. That means they've got sort of their initial approvals. We haven't seen them being fully greenlit just yet. And then it's the question, okay, what exactly are regulators planning to do about it, and will they really proceed full steam ahead on this approach as well?
We've got a presidential election coming up here in the States, and both the Trump campaign and the Harris campaign have kind of indicated a friendliness to the crypto space. Do you think that's going to be a factor in some of the conversations that happen in Hong Kong during FinTech Week?
Yeah, without a doubt. I think pretty much everyone would tell you where crypto heads is really based on what the US does in terms of regulation. And it's been really interesting to watch that trading activity ahead of the US election, because you've sort of seen Bitcoin trading based on the expectations of Donald Trump returning to the White House. That's sort of changed somewhat because Kamala Harris has signaled more of an openness and at least a willingness to regulate the sector. And so you've sort of seen that evening out somewhat. What's interesting is if you take a look at what's happening in the options market, actually there's a lot of bets that are building for crypto, Bitcoin in particular, to reach $80,000 by the end of November. That would be a record high for the token. But again, it tells you that whoever enters the White House, many in the crypto industry would tell you it's going to be a positive for the industry.
So what's happening around stable coins, and does that compare in any way to what we're seeing in other areas of the crypto space?
Stablecoins has been really interesting. I think, again, it kind of comes back to what does the US do in this space? And we've actually just seen some inroads on that because there was another reintroduction, I guess. The Republican Senator Bill Hagerty, he's someone who's seen as being very friendly with Trump, very pro-crypto, but he's just introduced some amendments to the Payment Stablecoins Act. If that brings the regulatory clarity, we could see it being adopted elsewhere. But in Asia itself, actually Japan is seen as being one of the real standouts in this space. They already introduced their own legislation more than a year ago, and you're just seeing those sort of pilot programs that are taking place in Singapore, also in Hong Kong.
Annabelle, thanks so much for chatting with me on the crypto space as we look forward to FinTech Week in Hong Kong. She's Annabelle Drulers, Bloomberg tech reporter, and I'm Doug Krisner in New York. You can join us weekdays for the Daybreak Asia podcast, available wherever you get your podcast. Tom?
Thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.